Welcome back to the Deep Dive. It is Tuesday, January 20th, 2026. And, wow.
I was right.
If you've been glued to your terminals today, or even if you just, glanced at your phone on the way home, you know it's ugly out there. We're talking a sea of red.
It really is. I had to refresh my screen a couple of times. It's one of those days where the catalyst is so absurd you think it has to be satire.
Exactly. You assume it's a meme account, but no. We are dealing with a massive market sell-off triggered by a diplomatic standoff between the United States and the European Union over...
Wait for it.
Greenland.
You can't make it up. And while the headline sounds like a joke, the damage to portfolios today was deadly serious.
It is. So our mission today is to cut through that noise. We need to explain why the S&P 500 and Nasdaq just dove over 2%, why gold is suddenly skyrocketing, and really answer the big question everyone's asking tonight.
Which is it just a weird panic, a simple rotation in a bull market? Or are we actually seeing the start of something much deeper, a structural shift people are calling the Sell America trade?
That phrase, Sell America, it just sounds so heavy. It sent a chill down my spine when I saw it. So let's get into the damage report. The closing bell just rang.
And there's really nowhere to hide. This wasn't a sector rotation where money just moves from, say, tech to energy. This was a liquidation.
Right.
The S&P 500 closed down 2.06%. Nasdaq 100, it took the brunt of it, down 2.12%. And even the Dow, which sometimes holds up a little better, dropped 1.76%.
And that uniformity is what's so scary. It's the very definition of a risk-off day. Okay, so let's dig into the catalyst. President Trump has escalated tensions over this Greenland idea. I mean, we've heard it before, but this is different.
Escalated is putting it mildly. The administration is furious, apparently, that Europe won't even entertain the idea. So the response is a threat of, massive tariffs.
What are we talking about here?
We're talking 10% on European goods starting February 1st, ramping up to 25% by June. There was even talk of punitive tariffs up to 200% on specific items.
Right, I saw that. Targeting 8 countries and... of course, French champagne. It feels like the old trade wars, but just on a whole new level.
It's much more aggressive.
Yeah.
And the market's reacting so violently because Europe isn't blinking this time. France specifically signaled they might use the anti-coercion instrument.
I saw that term floating around. It sounds incredibly bureaucratic, but the market treated it like, I don't know, a declaration of economic war. What is it?
Think of it as the EU's economic nuclear option. In the past, it was tit for tat. The U.S. tariffs steel. Europe tariffs bourbon.
Right.
This instrument is different. It's a structural framework that lets the EU retaliate with broad, sweeping measures without needing a vote from every single member state every time. It's designed for speed and maximum economic pain.
So it basically removes all the diplomatic breaks. It's built for rapid escalation.
Exactly. And markets hate that. But here's the really important part, the part that feeds into this whole Sell America narrative.
Yeah.
Usually in times of geopolitical fear, investors run to safety. And for the last, 80 years, safety has meant one thing, the U.S. dollar.
The classic flight to safety. Stocks go down, the dollar goes up. That's the playbook.
But that did not happen today. And this is why this sell-off is different. While the U.S. stock market was crashing, the U.S. dollar index, the DXY, was actually down 0.80%.
That's the anomaly. That is the flashing red light on the dashboard.
It's a massive anomaly.
Yeah.
It suggests global capital isn't just afraid of stocks. It's afraid of the U.S. asset class as a whole. They're not just selling stocks to buy dollars. They're selling stocks and dollars to get out of the system.
So money is flowing into, the Swiss franc?
The euro?
Into the Swiss franc and the euro, ironically enough. It implies a loss of faith in the U.S. as that impartial safe harbor. If the U.S. is going to weaponize trade over a territorial dispute, maybe the dollar isn't the safest place to park cash anymore.
A crisis of confidence. Precisely. And if you really want to see where that anxiety is screaming, you have to look at the bond market. Yeah. Because that's where a Sell America trade shows up first.
And it absolutely showed up today. The U.S. 10-year Treasury yield just spiked, hit 4.75-month high, sitting around 4.31%.
Yep, 4.31%.
So for anyone listening who doesn't track basis points every day, why is that number so scary? Why does that break things?
It's all about competition for your money. That 10-year yield is the risk-free rate. When it spikes like that, it does two things. First, it makes borrowing more expensive, which crushes growth stocks. But second, it gives investors a really juicy alternative.
It's the T-bill and chill argument, right? Why should I risk my money on a tech stock that could drop 20% over Greenland when I can get a guaranteed 4.3% from the government?
Exactly. The higher that yield goes, the stronger the magnet pulling money out of stocks. But there's another deeper layer to this. It's not just a U.S. story. We're seeing what some are calling the Japan contagion.
I wanted to ask about this. Japan is the largest foreign holder of U.S. debt, right? They own a huge slice of our treasuries.
The largest. And today, Japan's own 10-year government bond, the JGB, hit a 27-year high.
A 27-year high, that's a generational shift.
It is seismic. And here's the nightmare scenario for the U.S. Treasury. If a Japanese investor can finally get a decent return, say over 2%, at home in their own currency, why would they keep buying our bonds?
They wouldn't. Or worse, they'd start selling the U.S. bonds they already have to bring that money home.
Exactly. And if your biggest customer goes on strike, what happens? The U.S. has to offer even higher interest rates to attract new buyers. That pushes yields up, which crushes the stock market. It's a vicious feedback loop.
And just to add fuel to that fire, we have this drama around the Federal Reserve now, questioning its independence.
That's the third leg of the stool. You have external pressure from Japan, tariff pressure from Europe, and now internal political pressure. Rumors of an investigation into Chair Powell talk about potential replacements. Kevin Warsh versus Kevin Hassett.
That's a battle of ideologies right there.
It is. And markets need stability from the central bank. If investors start to believe the Fed is being politicized, the risk premium on all U.S. assets goes up.
So it's a perfect storm. Geopolitical crisis, a bond market plumbing issue, and an institutional credibility crisis.
All hitting at once. But even with all that macro gloom, we have to look at the market's internal structure. Because today, the machinery itself broke.
You know, we're talking about the gamma flip. This is a big one. And before we really get into the mechanics of that crash, though, let's just take a quick second.
Yeah, good idea. If you like what you're hearing today, we invite you to subscribe to the channel, leave a like, and comment on what topics you'd like us to cover in future episodes.
In the description of this deep dive, you will find a PayPal link if you want to support this project.
Your contribution helps us keep creating content like this. We don't ask for more than the cost of a coffee. Thank you for your support.
Okay, let's get back under the hood. So we've covered the macro, but let's talk plumbing. The Nasdaq, specifically QQQ, broke its 50-day moving average. And you said this gamma flip happened around the $615 level. Walk us through this simply. What happens?
Right. So, okay, think of market makers, the big dealers, as the shock absorbers for the market. In a normal environment, what we call positive gamma, if the market drops a little, they buy. If it rallies, they sell. They smooth out their buy.
Provide stability. They keep us from getting seasick.
Exactly. But when the market drops below a key point, which was $615 today, the math flips. We enter negative gamma. And now those shock absorbers become accelerants. When the market drops, dealers are forced to sell into that weakness to hedge their own books.
That is just terrifying. So the market drops, which forces dealers to sell, which makes the market drop even more.
Which forces them to sell even more. It's a cascade, a doom loop. And today we had this massive put wall sitting at the $600 level.
A put wall. Explain that.
It's just a price level where there is a huge concentration of put options bets that the market will go down. So as the price gets closer to $600, that level acts like a magnet. The gravity of those positions just pulls the price down toward it.
So the bottom line is that in this kind of environment, the market has no natural stabilizers.
None. If you're watching your portfolio, you just have to expect these violent, sudden intraday swings. The mechanics are working against stability right now.
Which brings us to individual companies. We just got the kickoff of tech earnings with Netflix, and honestly, the numbers looked solid.
They were better than solid. They were a clean beat. EPS came in at 56 cents versus a 55-cent estimate. Revenue was $12.05 billion, beating estimates.
In a normal market, that stock should pop. But Netflix fell about 5% after hours. Why punish a beat?
Because in a nervous market like this, the past doesn't matter. It's all about future risk. Netflix gave guidance for 2026 growth of 12 to 14%.
Which is still pretty respectable, but I guess not enough.
It's a slowdown. They did 16% in 2025. And slowing growth in a high-rate environment is a death kiss. But the real issue, the thing that really spooked investors, was the merger news.
The Warner Bros. Discovery acquisition, they changed the deal, right?
They did. They amended the offer to be all cash. That's a massive amount of cash going out the door.
And here's the kicker. To pay for it, they have to pause their share buyback program.
Bingo. Buybacks are a huge support for stock prices. So Netflix is pausing that support, taking on a $42 billion bridge loan. So you've got more debt, less cash, no buybacks, and slowing growth.
Investors just looked at that whole equation and said, nope, I'm out. It's a great lesson that earnings are not just about the headline number.
especially when the cost of that debt, that new loan, is going up every day because of the bond yields we were just talking about. It's all connected.
So if investors are selling U.S. stocks, the U.S. dollar, U.S. bonds, where is the money actually going? It has to land somewhere.
It's going into real assets, hard assets. We are seeing a historic move into commodities.
Gold and silver are having an absolute moment.
A moment is an understatement. This is a breakout. Gold hit an all-time high, crossing $4,750 an ounce. Silver surged about 5%, breaking $95.
4,750 for gold. That's a staggering number.
Is this just old-school inflation fears, or is it specifically tied to this geopolitical weaponization idea?
It's the latter. It's the weaponization. Think about it. If you're a global investor and you see the U.S. using the financial system as a weapon over a land dispute, you want an asset nobody can freeze. You want an asset that isn't someone else's liability.
And that's gold.
That's gold. It's pure insurance against geopolitical chaos.
And it wasn't just precious metals. I was shocked when I saw natural gas today, up 26% in one session.
That ties directly back to Greenland.
Connect those dots for us.
If the U.S. and Europe are in a diplomatic standoff, the market immediately starts to price in disruptions to energy trade across the Atlantic. Europe is still very dependent on LNG imports from the U.S.
And if that supply chain gets caught in the tariff crossfire, prices skyrocket. The gas spike is the market pricing in a physical breakdown of trade routes. When diplomacy fails, energy security is priority number one, and the price reflects that panic.
It really is a convergence of everything going wrong at once. So let's try to summarize this wild Tuesday. We have a diplomatic crisis over Greenland that's moved into actual economic threats.
We have Japan's bond yields hitting multi-decade highs, threatening to pull liquidity out of the U.S. system.
And we have the U.S. market's own internal plumbing, that negative gamma making every single move down even worse.
That's the whole picture. Macro, micro, and market structure all flashing red at the same time.
So here's the provocative thought I want to leave everyone with tonight. For the last couple of years, this bull market has just shrugged off headlines. Politics was noise. But today, it feels like the market repriced geopolitics in a single session. So is this just a breather? A harsh rotation? Or, with this Sell America trade gaining traction, are we watching a structural shift where 2026 is going to be defined by volatility?
That is the trillion-dollar question. When the rules of the global game change, markets have to find a new equilibrium. And as we saw today, that process is rarely smooth.
And with that, we reach the end of today's deep dive. We hope you liked it, learned something new, and will join us for the next one.
Thank you very much, and we'll meet again very soon.
Remember that the PayPal link is in the description if you want to help us out. Thanks once again.